In this recording, we're going to look at one question from the question pack in IAS 38, focused particularly on a number of projects with different scenarios around the application of IAS 38 rules. So we'll start at project 1 and we'll work our way down. So project 1, you're given information that they had deferred development expenditure, so like an intangible asset, at the start of 2017 of 400, and they made more development expenditure during 2017. And what you're told is this project was originally expected to be highly profitable, which I suppose why it was originally capitalized and it had an opening balance, but is now in doubt as a high-profile scientist in charge has left the company for a competitor. So this is an actual particular scenario where now the commercial and technical feasibility of the project is in doubt. So what that means is the criteria is no longer met. So IAS 38 criteria no longer met as project is in doubt. So you're being conservative here saying, well, hold on, this has taken a significant change. The high profile scientist in charge of it is gone. So do you have the resources and capabilities to complete it? And if that's the case, you need to expense all the previously capitalized expenditure. So what we're going to do there is we're going to debit the SOPL this year, 447, which is the 400 from previous years. You're going to write that off, and the 47 you spent this year, because the project is no longer looks to be feasible, so you need to write it off. Debit the P&L expenses, credit bank 447. Now that's 447,000. So just make sure we keep it at full figures. So our key takeaway there from project 1 is even if in the past the development criteria were met and it was capitalized, if the circumstances change, you can reverse that capitalization and write it all off. You don't need to go back to the prior year to do it. You can write it all off in the current year when the circumstances change. Project 2 is a different one now, in that here we have no money in deferred development expenditure. It's all expensed in this year, or incurred in this year, should I say. They said 400,000 has already been written off in previous years because it didn't meet the criteria. However, they now believe on the best advice that the project will earn revenue considerably in excess of development costs and now wish to reinstate the development expenditure previously written off. So the rule in IAS 38 cannot reinstate previously expensed items, expensed costs. You can only work from this year onwards. So you can capitalize the 2017 expenditure, because based on the wording, it looks like it is going to meet the criteria. We wouldn't really list out each of the 6 criteria. You know, those pirate criteria we talked about in the live webinar this week. What we'll give you an indication in terms of the general, is it going to be commercially feasible or not? And this looks to be commercially feasible. So that means you're going to be able to debit intangible assets, which is deferred development expenditure. That is an intangible asset. You're going to be able to do that 33, 2, 15, and 2. You're not allowed to do the 20 because the 20 is market research costs. They're not allowed to be capitalized. So on this one, you're going to be doing 33 plus 2 plus 15 plus 2, which is 52,000. You will debit the SOPL, the 20,000, because it is a market research cost. That's not allowed to be capitalized, and you credit bank 72,000. So that is the rule there. You will amortize that then when you start earning revenue from the project. Generally, we hold off until the project is finished, but there's no guidance here whether that's going to happen or not. So for now, there's no amortization. You leave it at 52,000 in the non-current assets. So project 3. So again, these are nice little projects just giving us an idea of exactly what's happening. So no expenditure this year, but there was deferred expenditure of 570. And that's because this project is actually finished and it's starting into commercial production. Sales were 30,000 this year, 60 next year, 40 the year after, and 10 the year after. So total units in the project overall, if we add them up, 30 and 60 is 90, 90 and 50 is 140,000. Of that, in 2017, you're going to have 30,000, which represents what percentage? About 21.5%. So that's the basis here. Sometimes you will amortize based on the number of years, but it often makes sense to amortize based on the number of units if the number of years are not even. So you can see here there's much heavier production in earlier years than in later years. So it makes sense to amortize the cost to match it over the expected future sales. And because there's no sales expected after 2020, you amortize finishes in 2020. So that's kind of like essentially the useful life. So you're going to amortize in 2017 the 570,000 times 30 over 140. So 30,000 sales this year over 140 in total. So you just pro-rated based on the percentage of sales of product. So that would be here 122,143. So as long as you get somewhere like that, there might be a bit of rounding, that is fine. So you will amortize that this year, debit SOPL expense, credit accumulated amortization. And it's the 122,143. Now, another one is you could amortize it over the number of years, divide by 4 years, but it's not a reflective of the matching because you're matching how much sales are made in each year. So to do it on a unit basis is probably more realistic there. So the net value at the end of year 3 for project 1 will be 570 less accumulated depreciation of 122. That's how it will be presented in the financial statements. So that's the third project. The fourth project then, project 4, it has no deferred opening balance, but it has a number of expenditures this year. You're told this relates to a new compound which meets the criteria for deferral, and the development is expected to take 3 years. So it's not going to generate any money for 3 years. So in this case, the criteria is met. So you just debit intangible asset. Be careful. You only debited the 60 plus the 2 plus the 12, which is 74,000. You will debit the SOPL, the market research costs, 4,000. They are never allowed under IAS 38. Right? Market research costs are not a directly attributable expense. They'll have to be written off to the P&L in 2017 in the current year. So that's a simple one. So your closing balance, you won't amortize that because it's still in development for the next 3 years. It's only once the project is ready for use do you start amortization. And finally then, project 5. Project 5 again has no opening balance, but they've spent 29,000 during the year. This is another new project involving the development of a loss leader, expected to raise level of future sales. Now the key thing here is this project is not going to be profitable. You're told it's a loss leader. So in IAS 38, because it is a loss leader, you're going to not profitable. So does not meet IAS 38 criteria. So that means you're going to expense it all. Debit SOPL, credit bank, 29,000. You might say, well, surely it's going to increase future sales. The key point here, the project itself is not going to generate future income as standalone. And that's the way they look at it here in IAS 38. So what you're going to do is you write it off as an expense in 2017. Debit the P&L, most likely admin expenses, and credit the bank. So that was your first requirement in question 1. Explain the required accounting treatment and provide the necessary journal entries. Right, so that's what we've done there. We've gone through each of them. We've given the correct journal entries. Some of them had to be reversed. Some of them had to be amortized. Some of them had to be put straight to the P&L. The second part of this question asked you, explain how the cost associated with the trade fair and staff training should be accounted for. This is a bit of a trickier one. So this is part B. So it says during 2017, they spent 150,000 on overseas trade fairs, first time ever, but no orders came as a direct result. And they've also spent 300,000 on staff training and development. The company expects to achieve cost savings because of this training and development of 120,000 over the next 3 years. So let's take them separately. So the expense on the trade fair, now there's no clear set rules in this. It does come circumstance by circumstance. But the key point here is there's no direct benefit from the trade fair expense. No orders met. Now, one of the key definitions of an asset, intangible asset in IAS 38 is it must bring um, future economic benefits. And you can't reliably estimate those. You can't see whether they're coming from because you're not after getting any orders. So it is too indirect a benefit, too indirect to say there may be orders in the future. When they get in this thing about um, internally generated goodwill, that's kind of getting close to that. So you're going to have to expense the full 150,000 in 2017 SOPL. You have no other choice because it's unlikely you can justify doing anything other than writing it off because you don't have any orders coming in. It doesn't look to be generating a benefit. If you had some orders coming in, you might be able to justify some of it, but not with that line that tells you no orders have been received. With regards to staff training, well, the staff training is going to generate a benefit. Training does generate a benefit. However, company does not, and the key word there is control the staff. They can leave at any time. So the key point there, remember the other definition is you have to be able to control the asset. Now, this spending on staff training development and that return, that's really only a benefit if the staff train there or stay there and they don't leave. But when they leave, the benefits of training will leave also. So the point is that 300,000 is also an expense in 2017. You might disagree with that, but that's the key rules around the definition of an asset. The definition of asset is there has to be some economic benefit. There is here, but you don't control the asset because all that staff training and development, those people can leave, right? They can give their notice, whatever it is, a month or two, and they can leave with all that training and development as well. So you don't necessarily control those staff. That's why you will never see staff as an asset. Even though some, for example, accounting firms, one of their biggest asset is their people. You're not allowed to recognize people on balance sheet of any company. You will never see that because you can't control the people in a sense that you can't make them stay and make them perform. They can leave assuming they give their statutory notice period. So that creates a difficulty. Anytime there's staff training and development, that's always going to be an expense in the P&L as well. So there were two tricky ones at the end that I said I'd include just to give you an example of where it can be a bit of a grayer area and you're getting back into the core definition of what is an asset and do these particular expenses meet the definition. And that can happen when you end up going out on audits on your internship or when you start your graduate training in a year or two time. You might come across grayer areas in the real world where you have to go back to first principles and think, does this meet the criteria of an asset? Does it meet the criteria in IAS 38? All right, so that looked at question one in your pack in intangible assets, good coverage of different scenarios that can happen in projects, and also more commercial practical issues and how you might apply IAS 38 to solve them.